So hello everybody, and welcome to this webinar on the use of guarantee instruments by development finance institutions in response to the COVID-19 situation. I would like first to inform you that this webinar will be recorded. My name is Yasmine Galloul. I work for Bpifrance and for the ICR facility, which is organizing the series of webinars of which today's session is part of. I will be your moderator today. I will start with a very brief introduction of the ICR facility and then we'll present you the program of the webinar. So the ICR facility stands for Investment Climate Reform. It's a new technical assistance facility aimed at improving the business climate and making it more sustainable in the countries of the Organization of African, Caribbean, and Pacific States. It has been operational since the beginning of the year 2020. It's financed by the 11th European Development Fund under the ACP EU partnerships, as well as by the German Federal Ministry of Development and Cooperation and the British Council. And it is co-implemented by the GIZ, Bpifrance, the British Council, and SNV. The facility offers beneficiaries in ACP countries up to 90 days of technical assistance on very broad themes related to improving the business climate and its sustainability, especially in making it more inclusive, building on existing or emerging public-private dialogue initiatives. Requests can be submitted by public institutions like government, ministries, public organizations, or by private institutions like chambers of commerce or cooperatives, as well as by European Union delegations from member states. The interventions must aim at improving the business climate. They must also be part of a broader reform strategy and process and include always a PPD component. More information can be available upon request at the email address that you will see at the end of this presentation. The facility is based entirely on demands submitted by beneficiaries. So the agenda of today's webinar is very simple. It will be divided in 4 parts. First, the current introduction, which is coming to an end. Then the presentation made by speakers from Bpifrance, the French public investment bank, on the use of guarantee instruments. Then a question and answer session will be lasting between 10 and 15 minutes. You can ask questions during the presentation and during the Q&A session by clicking on the question button on your screen. And finally, we'll have a short conclusion and a presentation of individual sessions that we will be offering to those of you that are interested. So I now give the floor to Virginie Poncet and Vincent di Betta, who work at Bpifrance. Virginie.
Good morning, good afternoon, everybody, and good morning for those who are in a different time. So we are going to go through the impact, a quick overview of the COVID-19 impact on entrepreneurship, then the measure that were implemented in France mostly, but as well in Europe and Africa. And then we will go to the heart of the presentation, which is the credit guarantee. How does it work and how is it possible, and what is the method to deploy a guarantee fund? So to start with the consequences of the health crisis, it hit the whole world in a very dramatic and very sudden impact. The the channels of transmission of the crisis to companies were a global slowdown due to the declining of global demand, all on raw material export, services, tourism, project delays, disruption of supply chains. All those causes generated a very big decrease in all in worldwide economies. And this decrease in domestic activities also had an impact on public finance and on currencies. Globally, the world is at in a bad situation now, and all countries are working to design measures and implement all the possible plans to get out of this crisis. And you can see in the next slide how the world, the impact of the crisis of 2008 in the GDP of 2009. So you can see in yellow the still growing countries, even after the 2008 downturn, and in next slide, in 2020, this is the targeted growth of GDP in 2020, i.e. most of the world's countries are going to be in decrease rather than growth. So definitely this is the heaviest crisis since World War. The 1940 war. Next slide. And in this crisis, in this economic crisis, the SMEs are badly hit. There are always more fragile than bigger enterprises, mainly because they lack working capital, and they usually lack cash and trust from the bankers. Covid-19, on top of that, generated a big number of defaults and cascading bankruptcy. This led to even worse position of the banks towards SMEs. And on top of that, on the next slide, you can see that the banks are themselves in a difficult situation. Of course, they increased and they improved their equity due to the prudential solvency ratios that were generalized and more and more applied in the world. But in this period, banks have to face an increased number of defaults. There was an evaluation by COFAS that there would be worldwide, globally, 25% increase in corporate failures and 15% in France. And we will see that in France we've had an emergency plan that helped minimize those defaults. So the banks have to cope with their own problems, and so saving the enterprises is their role through debt, but they are going to be very reluctant unless some schemes, and in particular guarantee schemes, can help them to play their role as the financing actors of the economy. So Vincent, before I leave the floor to Vincent, I just wanted to show you that the economists have planned on the next slide a nice rebound in 2021. The examples here are countries that are not decreasing, do not reach zero growth, but still, and the economists plan that 2021 is going to be back to normal, hopefully, activity, but this will happen thanks to measures taken by the countries. That's all.
So next. Good afternoon, everybody, and thanks, Virginie. So each country implemented actions to counter the crisis according to the level of severity of the crisis in its own country, and sometimes with upstream protective measures with regard to what was happening in other countries. And the measures were also adjusted according to the country's financial means. So such example of measures, sanitary measures, regulatory measures such as containment, concerned with many people in the world, social measures, tax measures, financial measures, such as to postpone tax, for example. Next slide. And due to the economic cardiac arrest in many countries, there was an urgent need for action on 3 levels: financing the bank overdraft, addressing the liquidity crisis of SMEs, and support export, in particular to maintain the supply chain, which is a major risk in the globalized economy. And another very important action was to put in place to relieve the cash flow of SMEs impacted by the crisis, were made possible thanks to a very strong action to guarantee the credit granted by the banks. So a percentage of guarantee up to 90 and sometimes 20%. So it's not very common, but it was a very high rule action. Next slide. Some example. We have 4 examples. The first one is CCG in Morocco. Morocco is the first guarantee institutions of Africa. They settled in March, just at the beginning of the crisis, a very wonderful, relevant product, oxygen to finance, to guarantee loans granted by banks to finance liquidity of SMEs. And roughly at the present time, 95% of SMEs have an oxygen guarantee from CCG. And other example with VDC in Canada, with loan and guarantee program, very important. ICO and in Spain, and Bpifrance. So Bpifrance, the government implemented an exceptional guarantee scheme up to 3 billion euros called Prêt garanti par l'État, loan guaranteed by the state, to support bank loans for business and all business, small, medium, and big. And this guarantee is provided by Bpifrance to banks that grant those 90% state guarantee loans. Next, please. And our action, or our Bpifrance action made on certain key economic sectors, can be adapted to other countries in other economic priorities. In France, our priorities are tourism plan, a automotive plan, aero plan, plan touch for creative industry, and French Tech Bridge massive support for innovative startups until 2021. So we could share our experience with other countries on other economic priorities. And for the next slide, please, Virginie, for external investment plan. Yes.
Sorry. It's just to mention the external investment plan from the EU. Just this massive plan that was implemented in the previous years is now ready to help and support the countries to face Covid-19, and it is definitely for the development banks a good tool to go to support the recovery plans. And of course, in the scope of this external investment plan, i.e., as you can see, Africa, but also the EU Eastern neighborhood. So if we go through the presentation of the guarantee institution, the guarantee fund, on the next slide. Okay, so this part is dedicated to explain what is a guarantee fund and how does it work. The main principle and the reason why guarantee schemes are so much used and so widely used is that it's the best. It brings the best leverage to public money, and it also, as it is going through commercial banks, it has a very strong outreach. And as you can see in this on this scheme, in this slide, you have the commercial bank. When the commercial bank is giving a loan of 100, the exposure on the guarantee company is linked with the guarantee coverage. In the case of Covid-19, and that is the one also of the interest of guarantee schemes, the guarantee coverage is very high to take a lot of risk on the guarantee scheme and help the bank strongly to support the enterprises. In classical guarantee schemes, we usually put in place a 50% scheme, but here, where the crisis is very bad, for instance, as Vincent mentioned, the French scheme were up to 90%, but also there was some schemes like the Austrian plan that were up to 100%. And in that case, the bank has no risk, but it has the responsibility to choose and bring the liquidity to the client. So the commercial bank brings the liquidity. The guarantee fund takes, let's say, 80% of the risk, so 80 on the guarantee company, and the fund itself, the actual financial tool, needs the liquidity to cover the risk, i.e. the level of default. And let's say if in this case we have a 10% default, the fund will need to be funded by the state of 8. So to get 100 loan, the state needs to put 8 on the table. And we'll see a little further that it's can be even more efficient than that. And of course, this money has a very strong impact because it brings bringing money to the businesses. Then the businesses can employ or maintain employment, generate profit, and create added value, which brings tax revenues for the state, social benefits, and GDP growth. So the state indeed recovers its investment in the guarantee fund. Some evaluation were made, and Vincent is going to talk about that later. But at least by 2 is a very common vision on guarantee fund. And on the next slide, this is how really practically the guarantee works. The management company, like Bpifrance, for instance, when they deliver a guarantee, it's after a company has asked a bank to do a loan, then the bank goes to Bpifrance. Bpifrance grants, gives a guarantee agreement to the bank, and then again the bank gives the cash, grants the loan to the company, and the loan is done. Then when it comes to default, the company is being in default, so does not pay back the loan. The banks starts the procedure and then ask the management company, Bpifrance for instance, the compensation for the loan. And then there are two cases. Either, as it is in France, Bpifrance waits for the banks and the company to go through the procedure all the way along until the end of the procedure, and then Bpifrance pays back the bank. Or if it's in first demand, then the Bpifrance pays back the bank up front. So that's the mechanism of the guarantee. So definitely the bank is protected, and that's what we want to do. We want to protect the bank so that the bank does more, and then we as a guarantee fund use the bank as a multiplier, as the front office of the guarantee fund. And if we go next, and the economic model is that. So the guarantee fund is funded by public institution, the state, but it could be the EIP, the European External Investment Plan, for instance, or EIB, or the European Investment Bank, or the African Development Bank, or any other institution who do invest in guarantee funds. But the guarantee fund has revenues, because the guarantee, when it's given to the bank, is to be paid by the bank. There are fees for the guarantee. So this is one resource for the guarantee fund, and the second revenue for the guarantee fund is the financial revenues of the placement of the fund. And of course, the cost is the payment of the guarantee in case of failure. So here you can find on the right of the slide the what we call K is the leverage between the resources of the fund and the capacity of the fund to guarantee credit. So again, the fact, so we can go on the next slide. Those revenues to the fund diminish the requirement of funding from the donor. So in the case I mentioned in the beginning, instead of funding 8, maybe the state can fund 4, and the fund even that way can be sustainable. This balance has to be calculated. It's a bit complex to evaluate exactly the leverage, the capacity of the fund, and the requirement for funding in the beginning. It depends on many criteria. The rate for placements, the level of fees, the capacity of the banks to pay the level of fees. So there's the right balance, the level of the fees, and also the payment of the management company, which here is mentioned, because the guarantee fund and the management company are two separate entities. Sometimes the guarantee fund is within the management company's balance sheet, but it may be off balance sheet. So anyway, the management company has to be balanced as well. It has to be paid for its work through fees and financial products. And so those fees and financial products have to be shared between the guarantee fund and management. So all this balance is quite needs an elaborate calculation, and the business plan of the guarantee fund is to be evaluated. So we can move on to the next slide. There are plenty of characteristics of a guarantee, but what I wanted to tell you mostly is that defining a guarantee is a question of balance. A balance between managing a fund, and when you manage public money, whether it's from the state or a donor, you need to be as efficient as possible with that money. You need to be protective of that money. You need to manage the risk, but you also use that money to push the banks to do more. So you want to subsidize the banks, sort of subsidize the banks, so that they do as much as they can with very well managed money. So you need to navigate between taking as much risk as possible and protecting the fund. So that's why the characteristics of the guarantee fund is a constant exercise to adjust those characteristics. And of course, a guarantee needs to be granted where it's needed, avoid high risk, and manage the collateral, because the guarantee fund is also there to protect the collateral of the enterprises. And on the next slide, you can see many other characteristics. Like if you manage the guarantee in a portfolio way, you need to evaluate the commitment amount for the bank, the unit commitment amount per enterprise, the level of data exchange, then the beneficiary targeting, the size of enterprise, the sector of enterprise, the scoring, the risk evaluation of the enterprise, etc. Then you have the credit criteria, whether you the type of transaction you want to guarantee. You may create dedicated guarantee for, let's say, leasing, or for short-term, if you want especially to improve the treasury of SMEs, for instance, etc. And then you have the collateral rules. For instance, in Bpifrance, we forbid the banks, or we do not guarantee the credits if the bank takes the home residence of the entrepreneur as a collateral, which is very often the case. So we want to avoid that, not to take this type of risk. And on the next slide, you have some other criteria. Duration, of course, the longer, well, duration. Yeah, the safety period is interesting. If you want to avoid some moral problems, you can and prevent some banks to use the guarantee fund in an excessive way. You can just decide, and we do that in France, the 9 first months of the credit, if there is a failure, and sometimes it's up to 1 year, between 6 months and 1 year, it depends on the fund. If there's an early failure, the guarantee doesn't work. And then the guarantee coverage, when we say we guarantee at 90%, this is the maximum. In some cases, we can adjust. If 90% is not needed, we can go below that. And then the duration, the exposure, and then also there's the collection of fees, which is very important. Collecting the fees flat upfront or with the installments is a very different method. Knowing that flat and upfront is much safer, but well, so those criteria are very very important. And next slide, please. I think we are almost finished. Yeah, this is the same thing as the first set of criteria. Always balance between taking risk and protecting the fund. This is how you have to design the fund, and it is not obvious. You need to be very careful, and this is why the method for the design of the fund is has to be a structured part, as Vincent is going to explain to you. Vincent, je te laisse la parole. On ne t'entend pas?
Next slide, please. Thank you. So, and whether the sanitary impact of the COVID is high or low, the economic and social impact will be major for all countries around the world. And the answer to COVID is to create jobs. So, and in the past, it was very important to facilitate the access of SMEs to bank loans, and now it's more important and more important because of crisis, the present economic crisis and the future economic crisis is very important. So we have to fight against the economic crisis. One of the solutions is to settle a guarantee fund. Next slide, please. Yes, and the key success of the implementation of the guarantee fund could be summarized with 5 points. The first of one, to create and to develop a close partnership with all the ecosystem. It's impossible to create a guarantee company in the dark without working with all the ecosystem. So the success is to work with private banks, IMF, insurance company, international organization, corporate organization, SME organization, etc. A perfect governance. What does it mean? Responsibility, accountability, fairness, independence, integrity, primacy of the collective interest over individual interest, and discipline. Point 3, a perfect control of SME risk, very important. You have to implement close relationship and equal relationships between the guarantee fund and private banks. The ability to compensate the bank in the event of borrower default. If you have no capacity to pay the bank after a default, you can't develop confidence and you can't get files from the bank. And around that, it's very important to develop such organization, such as the rules of SMEs, in order to postpone the bankable aspect of a project. Next slide, please. So, 4 main points to build a guarantee company. So the structuring of a guarantee company must allow its development by optimizing public and private financial resources in a dynamic of performance and capacity to manage other specialized funds. That's why us, Bpifrance, we strongly advise to implement a private company with the state, but a small percentage of the state, and other shareholders such as private banks, insurance, international institutions. And then this kind of guarantee institutions need an approval as financial institutions, and this fund structuring allows for governance in accordance with international standards, with a board of directors representing shareholders and experts, an audit committee, and a risk committee. Other point, meeting shareholders' transparency requirements. What does it mean? For banks, IMF, and insurance companies, being a shareholder of a guarantee company would allow them to be present on the board of directors, and therefore favors a more balanced approach to strategic orientations during the debates. And the bank, IMF, or insurance company shareholder, through its access to complete information, has sufficient and necessary visibility to maintain its confidence in the guarantee fund, to which it entrusts medium-term risk coverage. Point number 3, independence. It's important to maintain, to promote independence of the guarantee fund, of the guarantee company. Independence from the state, independent from the private bank. So it's possible to put, for example, financial resources inside a private bank. If you want to cover all the ecosystem, it's important to develop a total independent guarantee fund in order to work with all the ecosystem, with all IMF and private banks, and to have a real lever effect on the country. And point number 4, meeting the transparency requirements of banking partners. The banker's compensation in the event of a borrower's default must be the subject of a clearly written process shared with the banking partners, a major guarantee for the credibility of the guarantee fund. And the banking partner bringing files to the guarantee company must have confidence in the said guarantee company that it will have a sufficient financial resources in the event of a default to pay the banking partners. Next slide, please. So, only with one slide, just to summarize all the different points, varying in different steps to build a guarantee fund. Because, as I said, the key of success of a project to create a guarantee company is based on trust. A trust that is built through dialogue, consultation, and adherence to a shared vision. First of all, it's important to do a market research. Why? Because you have to involve all the ecosystem with 3 objectives. First one, to explain to each partner of the country's ecosystem the context of the creation of this guarantee company. Objective, leverage effect, working method by involving them in our approach. Second point, to gather from private banks and IMF all the relevant figures to build a business plan and to know exactly how they work. What does it mean to SME for them? If they have SME information system, which kind of SME offer do they propose, and how many files studied, accepted, and etc. Number 2, financial projection and business plan. And with SME activity figures, collected from banks are used to establish business growth projection over 10 years, right, taking into account the probability of future default. And this projection shall be used to establish the overall amount of financial resources to be allocated to the guarantee fund when it is opened. Most countries, a lot of countries forget this point. And the guarantee fund will have to be endorsed with a minimum amount from the opening of the guarantee company representing roughly 10 years of operation in order to give visibility and credibility to the banking partners. Because the day a bank bring a file, a project to a guarantee fund, for example, this year, perhaps the company will encounter a default in 3 years, and the bank will be paid back in 6 years. So the bank has to be convinced that the guarantee company will be still alive in 6 years in order to be paid from all the default. Next, point 3, legal scheme. So we can discuss a lot about legal schemes. It depends from a country to another, etc., etc. Application for approval. So it is for not financial, not authorization for financial institutions, the appointment of a CEO, and business processes. Very important, because to build business processes such as file review processes, decision-making processes, process setup, litigation process, the guarantee company, the team of the guarantee company has to work with private banks in order to match all the systems and all the experience in order to be relevant the day at the opening of the guarantee institutions. And number 7, rating tool of unit risk SMEs. Because first, as Virginie said at the beginning of the discussion, faced with the problem of informal and financial or wrong financial accounts, the guarantee company will propose an approach based on a unit risk rating. So we develop Bpifrance risk guarantee tool in France, and we adapted this guarantee tool, the risk guarantee tool, in different countries, Russia, Africa, Mongolia, everywhere where we work, in order to determine the risk of each project, and then to determine the risk of all the portfolio of a guarantee fund. It's very important to create confidence with shareholders and financial institutions, because in order to put more money in the future. Point 8, fundraising. Okay. Point 9, team recruitment and training, and then launch of the guarantee corporation. Next slide, please. And when you create something such as a guarantee fund, it's important to be very simple. Only 2 types of guarantees to make something very simple: unit or case-by-case guarantee and portfolio guarantee. Second point, coverage rate roughly 50%, and guarantee payment in 2 steps, as like Aris from AFD. At the start of litigation, 50% of the bank, and balance of claim at the end of the recourse. And next slide, please. Next. So as a conclusion, I could say it's very important to allocate a financial resources for at least 10 years of operation, because if you don't have money, you can't it's impossible for banks to have confidence in the guarantee company to be in capacity to pay in case of default. And we can see that there is a real lever effect when you have a guarantee institutions, because the growth of SMEs, they have to pay tax, charge, etc. And it's a virtual cycle, as Virginie told you at the beginning. And next slide, in order to underline this point. We published last week, it's very new, a very relevant study focused on Bpifrance and about 450,000 SMEs between 27 and 2017. And we can underline 3 main points. French commercial banks mobilized Bpifrance guarantee to finance relatively risky projects. For example, for startups, 40% of the beneficiaries are former job seekers, and 48% were former recipients of social minimum. It's a good example for many, many countries in which we work in Africa or Asia. Second point, a very significant impact on investment and employment. We can see, and we can share with you all the study, we can see that when the company has a chance to get a guarantee from a loan, it's easier for the company to grow, to develop new employment and to grow the activity. And last point, an effective mechanism in terms of the public resources mobilized. We are used to her, it costs a lot. And we can prove when it is well managed with governments, capacity to manage the risk, and strong relationships with banks, it's not a cost, it's an advantage. Because even if in France, the cost to create or to safeguard a job is roughly between 2,800 or 3,500, it's nothing compared to the cost of a crisis, the cost of default, the cost of unemployment. And for companies more than 3 years old, €1 of endorsement from the development fund, from Bpifrance, increases the stock of productive capital by about €26. So there is a real lever effect to settle national guarantee institutions inside the country. And in Africa, for example, there are three transversal guarantee institutions: African Guarantee Fund, FSR, and the last one in Benin, I forget the name, Fagas. And it's possible to mix the potential of a guarantee institution of the country with a transversal guarantee institution. So it was just few information about you, and we can discuss with questions now, and perhaps after the conference to have a special meeting with you in order to explain more the advantage for financial institutions to support guarantee fund in ICP. Thank you very much.
So thank you very much, Vincent. We're now reaching the part of the webinar where we're having questions and answer, where we can answer your questions. I encourage you to ask questions using the little question button. In the meantime, I can inform you that the presentation that was used today by the speakers is available for download. So you can download it and reference it later. The first question that I'll ask is directed to Vincent. You insisted a lot on the necessary independence of guarantee institutions. In a practical way, how can this independence be guaranteed, and how can political intervention be avoided?
Okay. When I say independence, it means a guarantee fund has to work with all the ecosystem, all the private banks, all the IMF, microfinance institutions. So that's why it's important to have the state as shareholders, but a very low percentage. That at the beginning, a guarantee institutions, it's a creation of a state, but the percentage of the state has to decrease and to take place to other shareholders, such as private banks, IMF, and international institutions. And independence means to be in capacity to decide alone a project. It's not an order, an obligation from the shareholders. They have to have a good, very relevant organization, governance, in order to be capacity to decide alone with their own institutions, with their own audit committee and a risk committee. And the independence means to be in capacity to say no, or to say yes, or to say it's impossible to finance this kind of project, but we could imagine another scheme for the project. Because most of the time, when you see all the guarantee fund, when in each country where a guarantee fund will be a disaster, they have forgotten governance, capacity to analyze the risk, capacity to decide alone, and they have forgotten to implement strong relationships with customers, that is to say, private banks and IMF. I hope it's the right answer to the questions.
If I may add something, independence is something very difficult because, and this is linked to a little bit to the next question. It is not so easy to create a private granting fund, and we take the example of Bpifrance. Bpifrance is a 100% public grant fund, not 100, actually 95 if the banks have 5% of our shareholders. But it is very difficult. But even though we are very public, which is of course also possible, we are a good example for that, it is difficult to be in capacity to say no to public servants. For instance, in France, we are heavily financed by the grant fund, are heavily financed by the regions, and it happens that a député, a member of the chamber of a member of the assembly, an MP, comes to the boss and says, "Oh, we have in our region this company. It's in difficulties. If you don't help us, we are going to lose 200 jobs in this very important city for the region." And we have to be able to evaluate that file, and if we consider it too risky, we must be able to say no, even though we know that 200 jobs are at stake, and we could help indeed. But we know that if we say no, it's because the risk is too high, and if we give the guarantee, it will not avoid the failure 2 years later, and it's not the way we manage a grant fund. So this is very delicate to manage, and we need to have this capacity to say no. So yes, we could be public, but if we are public, we need to have the right governance to allow us to be independent from the political side of the public scheme. If this is yeah.
Thank you. Another question I have is, in order to create a guarantee company in African countries, is it absolutely necessary to have a private guarantee law?
This is, well, what I was just saying, actually. No, it is not. Of course, it can work actually in Europe. It is very common that guarantee schemes are. Well, we have both public and private, and public schemes do function as guarantee. Bpifrance is a very good scheme, and many public schemes work very well. Again, the private, the fact that we push for more as private as possible is to avoid this political ingérence, political weight on decision we definitely want to avoid.
Okay, next question is, in the context of development cooperation, DFIs are often encouraged to use guarantee mechanisms to encourage lending to local companies and projects. However, guarantee mechanisms are often not ODA eligible, and therefore it's less attractive for DFIs to use these guarantee mechanisms compared to other instruments. Do you have any comment on this point?
Excuse me, I do not know what is ODA eligible.
Official development aid.
Ah.
So I guess what it means is that if you co-fund a project, you can't receive development aid if on the other part the guarantee mechanism is used.
Yes, definitely.
Okay, so okay, it's good to take note that this is the case. Does anybody else have questions? If not, because we've reached the end of the session, we're approaching the end of the webinar. So I will briefly present to you the individual sessions that go along with these webinars. Those are online sessions that are open to participants working in ACP countries, working for an institution or representing an institution from an ACP country. They're an opportunity for you to interact directly with the speakers, to ask them for clarifications or to examine the particular situation in your country or in your institutions. These sessions, of course, are free of charge, and they can be an opportunity for you to start an exchange that can continue maybe in a more in-depth form later on. So for any information and to register for these sessions, please write an email to the address that appears on your screen, icrfacility@giz.de, within a week, so until the 30th of June. So these are very good opportunities for you to have more information from our two very talented speakers. So we have now reached the end of this webinar. I would like to thank the speakers for their presentations. I would also like to thank all the participants for their attention and for the questions that were asked. A small satisfaction survey will be displayed on your screen, and we would appreciate if you could take a few moments to fill it out. So thank you to everybody, goodbye, and maybe see you soon for the individual sessions.